This is a second video that covers how to handle consolidation at the date of acquisition. So we're required to prepare a balance sheet at the date of acquisition. And so we have to go through several of the steps of consolidation, and it's a good way to get used to the first part of what an acquisition involves. Okay, so in this case, a parent purchases 100% of a subsidiary on 11A and issues to the shareholders of the sub 100,000 shares of stock at $7.5 each. Now make sure you really understand that that stock is not going into the hands of the company, it's going into the hands of the shareholders. They're getting the parent stock, just as in earlier problems, they got cash from the parent. So they give up their shares of stock to the parent. The parent company holds those shares, but it doesn't affect anything on the subsidiaries' books. This is a little different than the earlier example video that covered acquisitions because we have understated assets in this case. There's two of them. The property, plant, and equipment has a fair market value that at the date of acquisition should be only $320,000. If you go down here though and look at the property, plant, and equipment, the sub has it still listed on the books at $400,000. So maybe there's land or property that's lost value, there's equipment that is still on the books but turns out not to be worth as much. So we're going to have to deal with that when we consolidate. We have to use all the new information that we have at consolidation. This is a little different as well. The inventory is reviewed and determined to have a fair market value of only $400,000. When we look at the inventory on the books of the sub though, it's $447,000. So maybe the parent and the sub go through, do a little bit more vigorous or rigorous lower of cost or market analysis, find there's inventory that's overvalued. So that also has to be taken into account on the date of the consolidation. So I started up here with the usual work. By the way, everything else is at fair market value. And here is our preparation, at least the first couple years, of the differences between fair market value and book value. We really don't need it at all for the acquisition, date of acquisition consolidation. We only really need this information. But we're using, again, the 2-column per year. So notice this is a negative. We need to write down the property, plant, and equipment. When the property, plant, and equipment becomes worth less, there should be less depreciation. That means the expense goes down, and we always add back in to make that expense go down. And that happens every year, and 10 years. Inventory, it says over here that it's FIFO. So we have that inventory, we write it down. Because we're using a FIFO method, the impact of that write down should flow through in the first year. So we have inventory that's worth less. That's going to save us some cost of goods sold. So cost of goods sold is an expense. This is really the income impact, and our cost of goods sold is going to go down because the inventory that we're using up is worth less. A little bit difficult to see at first, but keep in mind that this is the effect on the balance sheet. So the balance sheet is losing value. This is the impact on the income statement. So the income is going up. We have fewer expenses, income going up. Now the next thing we need to do is do our goodwill. Again, the fact that we have overvalued assets will kind of affect this backwards. So let's go through this again. Here's the price that was paid, and I just took the number of shares, which was 100,000, and I multiplied it times 7.5. So there's our purchase price. This is the book value from the subsidiary's books. We can look down here. The subsidiary has common stock available, APC, additional paid in capital, and has retained earnings. Add those together, and that is 505. So the company, the parent, has paid an excess of book value of $245,000. Now, how can we explain this? It could be because the parent realizes that there are some assets that are not valued, but that's not the case here. The parent might think, oh, there's some intangibles that the subsidiary hasn't put on its books. No, that's not the case here either. What is the case here is that not only did they pay excess, they paid excess for these assets that are overvalued. So the whole amount of excess is the amount that's readily apparent because of the book value, and then the additional amounts of excess that are being paid because we now know that the property, plant, and equipment and the inventory was overvalued. That gives us a much higher goodwill than we expected. It's not the excess, it's the excess plus the fact that there are assets that are overvalued. So 372. Now we need to make the two middle entries in our first four entries. I think in the other video I mentioned that once we get into doing this yearly, we will also have a C entry. We will have down here an O entry, and then there's others that we could have. For the acquisition date, all we have to do is eliminate this equity investment so we're not double counting. Part of the reason we paid for this equity investment was the book value. So we eliminate the common stock, the additional paid in capital, and retained earnings from the subs books. Let me just remind you, that's these down here. Second, we have to restate our property, plant, and equipment and our inventory and put the goodwill on the books. Now, this is going to look a little funny to you because I forgot when I first did this that the property, plant, and equipment, here's the credits. So here's the debits, here's the credits. I guess we could get rid of this middle one, couldn't we? All right, so here we have two credits. So the goodwill should be first. The debits are always first. But anyway, we put the goodwill on the books. We decrease the value of the property, plant, and equipment. We decrease the value of the inventory, and that helps explain the amount that we paid, remember, in our calculations. So we're going to put that on our worksheet and then balance everything out. So let's look and see how this works on the worksheet. I know for some of you, worksheets are not something you've used very often. But once you're out working in any environment, you'll see that worksheets become very helpful. If we had two columns for everything, debits and credits for the parent, debits and credits for the sub, then these debits and credits, put these here, well, anyway, these debits and credits, and then on top of that, we had debits and credits for consolidation. This worksheet would be 1, 2, 3, 4, 5, 6, 7, 8 columns long at least. So an easier way to do that is to assume that everything that's in the parent and the subs columns are the normal balances. If they're not, we're going to put them in parentheses. So if we had, I don't know, negative sales, we couldn't have that. But let's say we got so much tax back or something that our operating expenses were positive. That's impossible too, but let's just say they were, or we had a loss in net income. That would be in parentheses to represent the opposite direction. So here are all our assets. They have debit balances. Here's the total. Notice that among those is that $750,000 investment in the equity of the sub. Then down here we have the liabilities, the additional paid in capital, common stock, etc., retained earnings. Our total equals our total. So we're starting out well. And here we have the subs information. Now we're going to get into the debits and credits by just posting these items. So we started out with the subs common stock, additional paid in capital and retained earnings. Here's those debits. And that has a partial impact of getting rid of some of this. Equity investment. Then we have, and don't get these confused because I did at first when I was making this worksheet and I was trying to figure out why things didn't balance. Don't forget that we're crediting property, plant, and equipment. We're crediting that inventory to take it down to a legitimate fair market value evaluation of those assets. But goodwill always goes on the books as a debit. Then we're going to do the same thing all the way across. I know if you're doing this by hand, it's a pain in the neck and much easier with Excel. We add our parents' cash to our subs cash. If we had any cash that was being added here, I'm not sure why we would add it. Any going out, we'd subtract, and that gets our final balance. So let's just go down to inventory. We have our beginning inventory from the parent. Here's the subs inventory at its old book value. We adjust that to go to market value. And here is our $1,900,000. Remember, another check is that part of what we're doing when we consolidate so that we're not double counting an investment and the value of the investment is to get rid of that equity investment account. So it has to come out to zero, and by the time we've made these two credits to what is a debit normal balance, we get to zero, so that always makes us happy. Double check that our assets equal our liabilities, and then you can prepare your balance sheet.